class is Financial Management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. Today we will cover part 1 of corporate valuation and financial planning. Topics covered in this chapter include financial planning, the additional funds needed equation, also known as the AFN equation, how to forecast financial statements using operating input data, and financial policy issues. Also, we will look at the effects of changing ratios. Financial forecasting is very important for the operation of a firm and also very important to figure out the value of a firm. When you forecast operations, you have to have various assumptions that go into it, which include the projected future income statements, projected financing surplus or deficit, and projected balance sheets. These will affect the free cash flow of the company. If we look at the valuation of the company, the free cash flows are all of the top terms here. And then also, it's going to affect the weighted average cost of capital, as these assumptions determined how much both the equity and debt cost for the company. So it affects both the numerator and the denominators in the discounted cash flow approach of valuing a firm. The financial planning process can be outlined as forecasting financial statements under alternative operating plans and trying to figure out which one is optimal, then forecasting the free cash flows to determine the estimated intrinsic value of the firm, attempting to maximize it, and you use this to determine the amount of financing needed to support the plan. Then you will make the decision of how to engage in that financing, whether it's going to be with equity or debt financing, and the type of equity, preferred, common, and the type of debt, short-term, long-term. Here is an example balance sheet for Hatfield. They had cash of 20, we'll assume in units a million, accounts receivable of 280, and inventories of 400. If we sum all of these up, we get total current assets of 700 million. These are so-called spontaneously increasing assets because as the sales of the firm go up, all of these have to increase to support those sales. That is somewhat opposed to net fixed assets. If the firm is operating below full capacity, those don't necessarily have to go up. If it is operating at full capacity, those have to go up too, and the total assets, the sum of the current assets of 700 and the fixed assets of 500 gives total assets of 1,200. If the firm is operating at full capacity, all of these will have to increase. On the liabilities and equity side, we have accounts payable and accruals. Accounts payable is the money that you owe to other firms, just like on the asset side, accounts receivable is the money other firms owe you. Accruals, on the other hand, is internal debts. Like if you pay your employees once a month, the increased amount of money that you owe throughout the month for your employee's salary. Also, you might pay your taxes quarterly, so the accruals for taxes go up each quarter. This firm has no line of credit, so its total current liabilities are 80, and these would be the spontaneously increasing liabilities, those that would have to increase with sales as the firm increases, as opposed to long-term debt, which is something that the firm will have to go out and borrow and will not automatically increase. The sum of these two is the total liabilities of 580. Currently, there are $420 million of common stock outstanding from initial sales, plus retained earnings of $200 million. So the total common equity, the sum of those two, is $620 million. Summing the total liabilities of 580 and the total common equity of 620, we get total liabilities and equity of 1,200, which of course equals the total assets of 1,200. How about the income statement for Hatfield? We're assuming sales of 2,000, operating cost excluding depreciation of 1,800. So the difference between those leaves 200, depreciation, which is not a cash flow, but an estimate of the decrease in value of the firm's equipment of 50. So the 200 minus the 50 gives us earnings before interest and taxes of 150. We have an interest expense of 40. Subtract that from EBIT, and we have pre-tax earnings of 110. At the time of the production of these slides, the total common corporate tax, state and federal, was 40%. So 40% of 110 is 44. Take the pre-tax earnings minus the taxes, and we get a net income of 66. Since Donald Trump lowered corporate income taxes, this number is probably slightly lower. Current dividends, $20. Of the net income, we are projected they are retaining earnings of 46, so that would be the net income of 66 minus the 20 in dividends leaves 46 in retained earnings. Common shares outstanding of 10. So earnings per share is 66 divided by 10 are 6.6. Dividends per share is 20 divided by 10 are 2. And then retained earnings per share would be earnings per share minus dividends per share are 4.6. And the ending stock price at the end of this quarter or year is $52.80. Selected additional data that we have that will be used to evaluate the performance of the firm is listed here. We have our particular firm, Hatfield, and the industry average. And to see whether Hatfield is doing a good job or not, we can compare their ratios with the industry average. If we look at operating costs over sales, Hatfield is 90, the industry average is 88. We would want operating cost as low as possible as a function of sales, so Hatfield is slightly underperforming the industry. Depreciation over fixed assets is 10, industry average is 12. If the depreciation was higher, that would lower their taxes. Cash over sales is the same as the industry average. Receivables over sales of 14 for Hatfield, 11 for the industry. If a company does not get paid quickly, well, they have to finance those receivables, which costs them an interest expense. So they would like to have this go down to the industry average to increase profitability. Inventories are also higher than the industry average as a function of sales. It again costs money to support those inventories, so you would prefer to have more like a just-in-time system and very low inventories. The fact that they have inventories above the industry average will make them less competitive and less profitable. It would make them perhaps able more to survive something like COVID or a labor strike or other issues. So there is some advantages to having higher inventories. There are, of course, some types of companies that have to have high inventories, like aging scotch. Fixed assets over sales is also higher than the industry average, so they are not as productively using their fixed assets. If they have a factory, maybe they're not operating at 24 hours a day, or maybe it's breaking down a lot, or maybe they just don't have as much demand for their products, so it's sitting idle. Accounts payable and accruals are the same as the industry average, and the tax rate is the same as the industry average. ROIC, or return on invested capital, is below the industry average, and one of the primary reasons for that would be, as we've seen above here, all their short-term assets are above the industry average, decreasing profitability down to 8, below the industry average of 12.5. The same thing will decrease their NOPAT, net operating profit after taxes, divided by sales, which is below the industry average at 4.5 versus 5.6. and their total operating capital is above the industry average as a function of sales, again indicating that they are not operating terribly efficiently and need to reduce their operating capital to increase profitability. The total liabilities over total assets for Hatfield is it's above the industry average, again indicating in this case they have more short-term debt obligations. That leverage could actually somewhat help them, but it doesn't seem to have been effective. Times interest earned for Hatfield, times interest earned is earnings before interest and taxes over interest. So you would want interest low because it's an expense, earnings before interest and taxes high. So you want this high, and it is well below the industry average, indicating too high an interest expense and too low an earnings before interest and taxes. This indicates then that they will have a low return on assets compared to the industry, and they do, and a low profit margin of 3.3 compared to the industry of 4.99, and they do. Sales over assets are total asset turnover. Again, you want assets low, sales high, so you want this to be high, and it is well below the industry average, again indicating a lack of efficient use of assets. Assets over equity are the equity multiplier. Sometimes there is an advantage to having it high, sometimes there is an advantage to having it low. In this case, they have relatively high assets versus equity, so they are a reasonably high leveraged firm compared to the industry, but it doesn't seem to be helping them any. Their return on equity is well below the industry average, and they are being punished in the stock market for this because their P/E ratio is at 8 and the industry average is 16, indicating investors don't particularly like their stock. A common way of comparing the performance of your company to the industry average is by using the DuPont equation, which allows you to split up your return on equity as a function of different parts of your company. So the return on equity is net income over sales, or the profit margin, times sales over assets, which is TAT, or total asset turnover, times assets over the equity multiplier. So if ROE is not doing well, you can say, well, is that due to poor net income? Is that due to poor use of assets, having too many assets versus sales? Or are you doing something wrong with leverage, either too much or too little debt? If we look at return on equity for Hatfield versus the industry average, we see our first term here, our profit margin, 3.3, is below the industry average of 4.99. Our total asset turnover, 1.67, is below the industry average of 2.04, and our equity multiplier is above the industry average of 1.94, below 1.56. So we are more leveraged, we are less efficient with using our assets, and we have lower profitability, leading to a much lower return on equity versus the industry average. So profitability ratios lower because of lower operating profits and higher interest expense, lower asset management ratios due to high levels of receivables, inventory, and fixed assets, which all cost money, higher leverage than the industry average. How about the AFN, or additional funds needed equation? How do we use that? Well, the AFN equation forecasts the additional financing needed by the operating plan. So the basic idea is you use this equation, which is derived from the basic equation of equity equals assets minus liabilities, and you use it to estimate the new assets required. You subtract new spontaneous liabilities, since those can finance those assets, accounts payable and accruals, and you subtract reinvested profit, i.e. net income minus dividends. Assumptions for our calculations: we're operating at full capacity at the time of our analysis, and that means if you are to increase output any, sales any, you have to increase both current and fixed assets. We assume sales are expected to increase by 10% next year. We assume the assets to sales ratio remains the same, no more efficiencies there. Spontaneous liabilities to sale ratio also remains the same, and the 2015 profit margin and payout ratios will remain the same. Definitions of the variables that go into AFN. S0 is the most recent sales. G is the growth rate in sales, our change in sales over sales. So S1 is the projected sales next year, which would be S0 times 1 plus G, or S0 plus delta S over S. The increase in sales, delta S, would be the growth rate of delta S over S0 times S0, which equals delta S. A star, assets required to support sales. Again, this will be all of the assets if you are operating at full capacity. If you are operating at below full capacity, it would just be the current assets. The spontaneously increasing liabilities are accounts payable and accruals. The capital intensity ratio, in this case, it's going to be all the sales over S0. If you were operating below full capacity, it would only be current assets. And the spontaneously increasing liabilities ratio is accounts payable and accruals over sales. Profit margin is net income over sales, and the payout ratio is the dividends paid out over net income. So here is a table summarizing our data for AFN. The growth rate in sales is 10%. S0 is 2,000, so S1 is going to be S0 times 1.1, or 2,200. The change, our increase in sales, is 0.1 times 2,000, or 200. We're told the profit margin is 3.3%. Our total assets is 1,200. Our capital intensity ratio is the 1,200 divided by the 2,000, or 60%. Our payout ratio would be the paid out dividends divided by the net income, and our spontaneously increasing liabilities was the $80 accounts payable and accruals. So the $80 divided by sales of 2,000 is 4%. And here is our AFN calculation. So the additional assets needed here is the 0.6, are the capital intensity ratio, which is the assets divided by sales times increase in sales, and that's 120. Some of that is going to be financed with spontaneously increasing liabilities, which we determine the liabilities ratio, are the spontaneously increasing liabilities over sales was 4%, increase in sales is 200. 0.04 times 200 is 8. And then some of it is also financed by retained earnings, which is going to be the profit margin, net income over sales of 3.3%, times next year's sales of 2,200, times 1 minus the dividend payout ratio, which is 0.697. So this is our retained earnings of 50.6. So some of our 120 is financed by spontaneously increasing liabilities. Some of it is financed by retained earnings, but that leaves $61.4 million that has to be financed somehow. So that's the additional funds needed, and that can be financed with new debt or new equity. So key factors of the AFN equation, well, sales growth. The higher growth is, the larger the AFN will be, other things held constant, because the higher growth is, the more new assets you need to finance your company's expansion. Capital intensity ratio. Well, if you are in a capital intensity industry like auto production, You're going to have a very high capital intensity ratio. You have to invest a lot of stuff to make more cars. If you are hiring a bunch of computer programmers, that's not going to be very high. So the higher the capital intensity ratio is, the larger AFN will be, other things held constant. Spontaneous liabilities to sale ratio. The higher the firm's spontaneous liabilities, the smaller the AFN will be, because the more of the firm's expansion can be financed with spontaneously increasing liabilities, like borrowing money from other companies to finance your operations. Profit margin, net income over sales. The higher the profit margin is, the smaller the AFN will be, because you're making more money to finance internally your expansion. Payout ratio, the lower the payout ratio is, the smaller the AFN will be, because you are paying out less of your net income to your stockholders. You're retaining more retained earnings to finance your expansion. If we take the AFN equation and we set AFN to 0, we rearrange it and solve for G, we will get the self-supporting growth rate. The self-supporting growth rate is the maximum growth rate the firm could achieve if it had no access to external capital. So we rearrange the equation, we solve for G, and we get profit margin times 1 minus the payout ratio times S naught divided by A naught minus L naught minus the profit margin times 1 minus the payout ratio times S naught. In our example, the profit margin is 3.3%. The 1 minus the dividend payout ratio is 0.697. This year's sales is 2,000. The assets needed for expansion are 1,200. Spontaneously increasing liabilities are 80. And again, here we have 0.033 times 0.697 times 2,000. We get 4.28% is the maximum growth rate we can fund with internal financing. And therefore, if we grow at a quicker rate than that, we have to go out to the capital markets and sell stock or borrow more money. So if Hatfield's sales grow less than 4.28%, the firm will not need any external capital. The firm's self-supporting growth rate is influenced by the firm's capital intensity ratio. The more assets the firm requires to achieve a certain level, the lower its sustainable growth rate will be. If we look to the future and try and forecast out farther, the forecasted financial statements, the basic approach is going to be forecast the operating items, sales, costs, inventory, etc. Choose a preliminary financial policy and use it to forecast the financial items, necessary long-term debt, interest expense, etc. And identify any financing surplus or deficits and eliminate it, again, by borrowing money or selling stock. And you do this until satisfied that the plan is achievable and is in the best possible interests of the company. And we will go into this in more detail in the second half of this lecture and the next video. I thank you for watching this video.